Hello, good afternoon, and welcome to this session on private debt and public debt. My name is Nina Flitman. I'm a senior editor at LCD, Leveraged Commentary and Data. And I'm joined this afternoon by an esteemed panel, Jean and Hervé, and I would like to ask them, first of all, to introduce themselves. Jean?
Yes, thanks, Nina. Good afternoon to everybody. J.Christophe, I'm one of two managing directors of Capveriant. I have 20 years of professional experience in the local public sector in France, Germany, but also in different other European markets that will include Benelux, Spain, UK, and Switzerland. My experience includes direct lending, but also infrastructure finance and advisory services. And people who are traveling in France would have used some of the infrastructures that had the opportunity to finance in the last 20 years, which include the Viaduc de Millau or the POPB, now Accor Hotel Arena in Paris. And this is also what I always loved in my business. Capveriant is a lending platform that it's a fintech that was set up by PBB Deutsche Pfandbriefbank that brings both sides, borrowers and potential lenders together in this public sector area. And since 2 days, we were very happy also to welcome Caisse des Dépôts et Consignations through la Banque des Territoires that took a participation of close to 30%. That was closed 2 days ago.
Thank you, Jean. Hervé?
Yes, thanks, Nina. I am H.Besnard. I am the CEO and main founder of Rivage Investment, which I founded back in 2010 after close to 15 years working with BNP Paribas in various positions in infrastructure financing and structured finance. So Rivage Investment is an independent asset management firm which is based in Paris, which is managing around 7 billion euros. And we are essentially a private lender in different subsectors. The sectors we are the most active in are infrastructure debt, where we have a range of senior and high yield debt funds, but also we have a variety of public debt funds, which is focusing on the French public debt sector. Our investors are essentially European insurance companies, and we have more than 60 large institutional investors who are invested with us, and our clients are essentially in continental Europe, from France, Belgium, Germany, Netherlands, and Southern Europe as well.
Thank you so much. We wanted to open the panel today. Before we get into a full-on discussion on the public debt sector, I just wanted to give you a real indication from LCD's point of view, from the leverage finance point of view, on what has been happening in the first quarter, because it has been a remarkable first quarter opening of the year. And just wanted to run you through quickly, for the sake of the audience, some of the trends that we have been seeing. I wondered if we can pull up the slides, our first slides. Thank you. So next slide, please. Let's get on to the meat. Here we go. So in the first quarter of the year, we saw a huge amount. This is from a private equity perspective of buyout debt. As you can see, it was the busiest first quarter for buyout financings that we've seen pretty much since the global financial crisis back in 2007. There had been lots of concerns. There was going to be, this time last year, there were concerns about liquidity squeeze. There was a concern about a real constriction in the market, that we wouldn't see sort of volumes bouncing back for several years. But as you can see, not only have volumes bounced back for buyouts, but they are the highest levels they have been in over a decade. Next slide, please. Thank you. What is remarkable on this side is that you can see that buyouts have been backed by bonds in a greater way than we have seen before, not just loan financing, but also high yield bonds in Europe. We have seen a number of really huge buyouts in the first quarter of the year. The average size of the buyout financing has reached over 668 million, which is pretty chunky. But we also saw several of these turning to the bond market in ways that they hadn't before. So, for example, the acquisition of Advanced Pharma was financed more through bonds than it was through loans, and some of the Asda, the acquisition of that in the UK, turned to the bond markets for some really quite large tranches. Next slide, please. So first up, I should say on this slide, you can see a very intentional error, unfortunately, at the bottom where the scale is the wrong way around. So we are moving from quarter 3 2014 through to 2021 on the far right, which is the opposite way around that the scale is suggesting. But it really shows how pricing in the capital markets has come back in from a place that it had been just last year. Obviously, we saw some widening out last year, but it's really returned to strength, and prices are at a competitive level again. We've seen a number of repricings, recapitalizations, and refinancings as sponsors have looked to take advantage of those particularly appealing terms. Next slide, please. Thank you. This shows how sponsors' funding sources have changed over time. So you can see, obviously, that bonds are, for the moment, much more interesting perhaps than they have been in previous years. This shows the proportions. This shows of 100% of the market, how much was through senior and through sub, etc. But actually, it's more remarkable. You can see it more clearly in the next slide, please. Thank you. Where you can see we've got a huge amount of loan volume, but also a huge amount of high yield debt. So actually in the first quarter of the year, there was over 32 billion of leveraged loans, which is the busiest it's been since 2007. That's across every use of proceeds, so not just buyouts. And also 14.6 billion of sponsored high yield bonds, which is the highest it's been since we started tracking that data in 2006. I wanted to show you some of this data just to show how the public debt markets have really returned to strength since last year, and especially for private equity issuers accessing the leveraged finance space. And I think we can just show the next slide briefly, and then thank you, and then we can end the thank you so much. I wanted to come to my panelists now, having looked at sort of where we are from a PE financing perspective, and also look more at the public debt markets as well, public debt financing. Now, Hervé, you started Rivage in 2010, as you mentioned. I wondered if you could speak to how you have seen the debt markets and access for private financing, how that has changed perhaps over the past decade or so.
Yes, I think the past decade has been quite unique in terms of how the market has completely flipped from a pure bank market into a market where private debt funds and institutional investors were taking a much bigger share. And in particular, infrastructure and public debt were sectors where it happens for, to some extent, similar reasons, which are that banks were more and more constrained by liquidity ratios and capital ratios, which was making long-term lending not any longer the favorite options for many of these banks, including the fact that some of the traditional lenders in this space, such as Dexia or RBS or DEPFA, stopped doing primary business. So it was a kind of a unique time in the financing history where there was suddenly a need for new players to join the market and to be able to work all together to provide better financing solutions to the borrowers. And this is true both for infrastructure debt, where typical PPP transactions would see 30-year lending, but this is also true, and even more with longer maturity, for public sector debt, where you have some sectors such as hospitals, which tend to have long-dated financing, or social housing, where you can have up to 60-year financing to finance the some of the real estate programs. And this is where institutional investors who were looking for long duration to put into their balance sheet with assets with a good credit quality, a good credit history, and also a modest capital ratio, were having hold their possibility to become players in this market. So we took advantage of the birth of this market for institutional investors back from 2010, and it has been keeping on growing and attracting more and more interest. All the more that with the very low rate environment in which we are, it is offering a spread pickup, which is very significant for traditional investors.
Where do you see the relationship between institutional investors and the banks that, as you say, traditionally dominated this sector? Presumably there's got to be some sort of balance between the two, or do you think this is going to move pretty much solely within the institutional sphere?
No. I think there will always be a balance between banks lending and investors, real money investors lending. I think banks are going to be always capable of underwriting and organizing financing for larger transactions, which is some things where funds are not typically geared up to do these kind of things in the debt space. I think banks also are the ones who have large, sometimes advisory teams, where funds do not have such big teams. So in competitive bidding situation, definitely banks will always have a role to play. And then there is the maturity profile. I mean, you have all kind of different appetite for different maturities. Some of the PE sponsors will be looking for shorter term financing because they want to have the refinancing much more capable of being refinanced when they sell the assets. Some others will be willing to have a financing which is linked to the actual economic life of the asset, and will be looking for longer dated financing. So I think everyone will find the right place and a space where to play and bring value. And I think it's more about being able to cooperate between different investors and banks and platforms to be able to bring the most value to borrowers and investors.
Jean, what's your view on the disintermediation we've seen in this market from banks through to a growing propensity for institutional investors from a Capveriant point of view?
Well, I suppose we, as a platform, we are the result of the trends that Hervé just described, which is this. I mean, the big lenders like Dexia and DEPFA disappeared, and as Hervé said, there are trends that make the business, at least the way it had been pursued in the last decades, less attractive for banks. So I think we will always have, as Hervé said, we will have banks. There is a room for institutional investors, because when you look at the way tenders, and now I'm focusing mainly on the French market, just for the ease of the explanation. But if you look at how banks are covering tenders in the French market, they are very well covering the needs in the range of 15 to 20 years. Beyond that, you rapidly see that there is room for institutional investors and real money investors that are the natural lenders. And what we try to do with the platform is to make that happen, or to ease the cooperation between those different actors. And our clients on the investor side are banks that are looking to digitalize some of the processes, asset managers and real money investors that are big enough and have the teams and the resources to act directly on the markets.
Where do you think the sweet spot is for the tenors? You've both talked about sort of the investors are looking for duration. Where do you think we're looking at the perfect spot for institutional investors in terms of maturities of debt, where they can really provide the best value sort of away from banks? Jean, perhaps you can.
Well, I suppose it's beyond 20, 25 years. I mean, and there are two reasons for that. First of all, as I just said, the banks are have less appetite for long tenders. And of course, in the interest rate environment, we have, whether you look at mid-swap or OAT or Govy as a benchmark, the longer you go, the higher the yield.
Mm-hmm, mm-hmm. Hervé, where do you see the ideal spot for maturities? Where do you?
I think it very much depends on which investors you are talking about. I mean, if you look at, and it depends on their asset liability situation. So if you look at France, for instance, you will have a sweet spot, which is probably around 8-year duration, which means that something up to 30-year amortizing for a small portion of their asset is completely acceptable. If you look at Germany, they have much longer duration, and some insurance companies will be looking to have much longer duration, something like 30-year, with maturities which can go up to 50 or 60 years. So I think it very much depends on the underlying market, the sweet spot in terms of duration. But overall, I think anything which is up to 20-year amortizing, so 10-year plus duration, is acceptable to institutional investors in general. And then if you want to go to the much longer duration, 15, 20, then you have sub pockets in specific markets.
What do you think the debt funds have brought to the market beyond the appetite for duration?
Well, I think it depends on which underlying market, but they have been bringing also the ability to be a buy and hold investor rather than looking to flip the asset, you know, as soon as they can. I think they have been also bringing agility. I mean, usually credit processes have become really time consuming in banks with many layers. I think debt funds tend to be more efficient to being able to process transactions much more quickly. Final techs are also relatively large. For instance, we can take final techs up to close to 200 million in our infrastructure senior debt financing, which is quite large and can also make a difference in some competitive situations. And then I would say ultimately it's reliability as well, because as the credit decision processes tend to be much shorter in asset managers, then we can provide a quick and speedy and reliable feedback, whereas sometimes in larger institutions which are going to look for syndication, it can be a long process where ultimately the last minute decision can depend on many different factors. So I think efficiency, ability to deliver large tickets, long duration are probably key, and ability also to arrange transactions, because a lot of structured finance people have been moving to debt funds. So the debt funds also have the ability to be a lender, or even to be a sole lender in a transaction.
Mm-hmm, mm-hmm. What is your sense of, in terms of looking at asset management firms who are active in the public finance space? Why do you think that we have seen, perhaps not quite so few, but why do you think that there is an attraction there, and do you think we're going to see this area build out more in the future?
Well, I think it has been an area with relatively few players, just because the spreads are relatively tight. So it means that the fees need to be relatively modest, which means that the business needs to be relatively large to make the necessary investment. Also, the skills which are required for public debt financing and being able to analyze the credit risk are very specific. I'm not saying that they are more difficult, but they are specific, which means that you need to have people dedicated to this asset class to really understand the way it works. And it's not the same law which is applicable. It's not the same legal framework which you are going to look into, and the same rationale. So you need to have specialists for this asset class. And I think it's the combination of this relatively low margin environment plus skills which are not there in the asset managers, which have left many of them away from this market.
Jean, where do you see demand from investors coming from? Where do you see new players coming into the market?
Well, I suppose if we look at the last year and a half, a lot of things changed. Because when we set up Capveriant back in end of 2017, we had a lot of institutional investors coming to us and willing to invest into this market, because the yields in the government bonds or even the covered bonds were so tight that they wanted to see whether there was potential in access in disintermediating those covered bonds and getting direct access to the assets. The pandemic, the interest situation has slightly changed sometimes the appetite, and nonetheless we see at least a growing interest also through the services that can be offered by the platform of investors, because I mean what Hervé addressed, we are trying, I mean, for people who have the resources and will have some specialized team, we're trying to make the access simply easier in the way we provide financial data about the borrowers, in the way we will provide some standard loan contracts if people don't have them, in the way we provide a certain number of services, including fronting banks, to ease this access. I mean, there are still a lot of other topics. The fact that the market is rather fragmented. I mean, in France, we're talking about 35,000 municipalities. In Germany, 12,000. I mean, if you limit yourself to local authorities with more than 50,000 and with a significant need for borrowings, then you have a smaller number, but you are still above 1,000. So the fact that it's a bank-driven market means that it also sometimes lacks transparency, and this is also where investors see the advantage with the platform, is that they don't need previously people who want to act directly needed to go through banks that in many respects and very often were actually also lender into the market, so with conflict of interest, and this is what we're trying to solve.
So with the market so fragmented, what changes would you like to see? I mean, apart from the digitalization that you're at the forefront of, what changes would you like to see to increase accessibility? Do they have to be regulatory shifts, or do we just need to see maybe a change in attitude that's going to come with time?
Well, I suppose it's manifold. We probably need to see a change of attitude. I think in the French market, we're seeing this change of attitudes and a growing need for diversifying funding sources and funding partners. And I mean, Rivage is also benefiting from this. We still have a pretty close relationship between borrowers and I would call them the historic lenders. And so you really need to have somebody within the local authority that is pushing for diversification, so that you're not only there to push conditions down. We probably need also to have a growing number of local authorities getting rated. I mean, I think in France you have 125 local authorities rated, which makes, and that brings me back to the point that Hervé was raising, makes the market not really accessible for many investors, because you simply don't have the skills to analyze the underlying credit risk. which is low, but still needs to be analyzed.
Hervé, I wonder if you can speak on that then, in terms of the demand that you're seeing from municipal governments, and also how you establish that relationship and overcome that need for a rating, perhaps.
Well, I think it pretty much depends. This need for a rating or not, it pretty much depends on which investor is looking at that, and which investor behind the fund is looking at that. Most of investors are going to look through, and depending on the nature of the borrower and depending on their internal methodology, if it's an insurance company, for instance, if they are using a standard approach or if they are using an internal model approach, then you might have different answers. But for many borrowers, you wouldn't need a rating if it's a city, a region, or if they have sufficient tax raising capacity in France. For others, for instance, such as some social housing or hospitals or some group of municipalities, then you would definitely need to have a private rating for the investors who would invest in these borrowers. And just maybe to add something on what Jean was saying, I think you have all kind of investors in the market, and this is what is making the market, by the way. And some will choose to invest through an asset management company because we will have the internal expertise, and some others will try to invest directly, and then will rely on what Jean is describing, on the services which are provided on the platform. So I think it's good because it will give different possibilities to investors, and some of them, even in what we see, are trying both approach, sometimes to invest through an asset manager and also directly, and then they compare what kind of returns they get, what kind of risk profile and analysis they can get as well. So I think it's good that you have these different possibilities for investors ultimately.
And presumably there's still a role for the banks in there, mixed in with them, obviously the mix of institutional and
absolutely, because one of the things we don't have as asset manager are as many resources as banks do have, or platforms may have for origination. So we have our own origination channels, but definitely banks will always have much more capabilities and resources than we do. So I think it's why working together makes a lot of sense.
Absolutely. In terms of the outlook, you've both talked about the duration of the market. What is your perspective on how things are going to change as the inflationary background changes? Are people sort of reassessing their appetite for longer term risks with the expectation that we're going to see a change?
It doesn't seem obvious to me. I think people have been caught by being short duration in general, and it has cost them a lot of money in terms of capital. And it's also a bit of a self-fulfilling exercise, because if you are short duration and rates go down, then you lose capital, so you need to be even more matched, so you need duration. So there is this kind of a counter-intuitive effect in the market, which is pretty much there. So I think in general, people don't take views on interest rates, or they take views on interest rates through other type of instrument than their main fixed income portfolio, which needs to be relatively matched. They will have either some option strategy, or they will benefit from their equity positions or private equity positions sometimes to get the inflation protection, rather than their main fixed income portfolio, where they still need to get duration. And if we think about some of the asset class, such as infrastructure, a borrower needs to be protected against rising interest rates. So in a transaction, you always need the fixed rate to be provided either by a bank providing a swap, or by an institutional investor taking a fixed rate tranche. But one way or another, it is a fixed rate world.
How do you see, obviously, the last 11 years or so of operating Rivage, you've seen a lot of development. How do you see over the coming decade, over the coming 10 years, you anticipate this market is going to develop, and what challenges you're going to face?
Well, I think first we are in a pandemic situation, which is not behind us, unfortunately. So first, I think we need to see how this will translate into actual credit losses or not. I mean, if you think about some traditional sectors such as airport financing, I think no one really knows where the story is going to end and when and how. So I think first, in the coming 10 years, definitely we will need to see what are the impact of the current situation on the portfolios and what it means to investors. Now, what is also going probably to happen will depend on rates. If they stay very low where they are, which is probably going to be, which is today the central scenario of many investors, very low rate environment. This is one thing. If rates go higher, it will reshuffle asset allocation. What is also happening, and which is in front of us, is all the new world in infrastructure, in particular, with digitalization, with decarbonation of the energy production, and the energy transition is there. So I think in the coming 10 years, we'll also be focusing on this new development, new sectors, and will be even more looking at all the ESG impact. And we are going to see, and we are starting to see from some of our investors, strong numbers behind this policy, not only data, but numbers. For instance, you have some large insurance companies which have already committed to reducing by a certain percentage, the carbon footprint of their portfolios. And when you know that on some of the portfolios, it's still pretty difficult to measure it, you can see that all the challenges we are facing. So definitely ESG will be a driver of the investment 10 years from now, and everyone is trying to be prepared and is preparing itself to be running at the right pace.
It does seem that this ESG topic has come up so many times across the conference today, across all the different panels that we've listened to. And it does seem to be a driver for development that we're going to see continuing to dominate conversations as regulatory changes come. But I guess the conversation might calm down once everything's been embedded a little bit, sort of, in a couple of years' time when we've all sort of got it into our stride a little bit. But it does seem to be something that we're going to have to factor in for several years on an ongoing basis.
No, absolutely. I think people need to be prepared to be able to measure, to have the right data on their portfolio, then to decide on which strategy is really making sense. And it will not be black and white. I mean, it will be a transition, and it will take probably years and a decade to be really going into the next level for ESG.
Sean, may I come at you with the same question in terms of how you see this market developing, what challenges you see along the way, and what potential we might be talking about at this panel in maybe 10 years' time, and also what your view is on how ESG is developing.
Yeah, and just to confirm that, I mean, coming back to your question about inflation, I can only confirm what Hervé said. I mean, in the discussion we have with investors currently, ESG and probably concerns around liquidity of the underlying assets, given uncertain times, are the two main topics we talk about. In terms of looking ahead, I mean, with all the difficulty that is linked to this exercise in the current environment, I mean, ESG is a big concern, and I think with the European taxonomy and reporting requirements, it's a topic that we will deal with for the next years and decades, which is also good. It has also a lot of impact on public investment, because obviously the public, the state and local and regional governments are big owner of real estate assets. They will need to invest a lot to bring those assets to make them energy efficient. Sorry. The relaunch of a lot of part of the programs that the state will launch in order to sustain the economy will also go through public investment in new areas, and they have already been mentioned by Hervé. But that will mean that local and regional governments across Europe will need debt, will need private debt to fund those investments. So actually, I think the demand will be there, and it should be also an interesting asset class, especially with the under this ESG relevant investing criteria.
Hervé, at the beginning of the conversation, you talked about funding hospitals and social projects. So presumably that fits in with the S side of ESG, sure. And this market is fundamentally suited to.
Social housing, waste and water treatment, utilities that are sometimes owned by the public sector, Stadtwerken and others. The refurbishment of buildings owned by the public sector that I already mentioned, public transportation policies, and many other topics. I mean, a lot of the investments that are actually conducted by the public sector have either social or an environmental aspect, if not both.
And obviously, Jean, we are seeing an increasing adaptation to digitalization. So obviously, the platform that you're working on with Capveriant is about introducing new investors to the market through a modern 21st century fintech platform. And yep. Presumably, this is just going to bring in more names into the market, more interested investors. And how do you see that growing?
Well, our purpose is definitely to bring more borrowers to. I mean, currently, and it's I will oversimplify, but you have large borrowers that can access debt capital markets and will issue bonds. I mean, Île-de-France, Ville de Paris, and a few others. And then you have a huge part of the market that are actually mainly financed by banks. And our purpose is really with the platform, with the services, to attract more borrowers. Some of them would currently probably ask their local banks what they can provide. They may even not send an email to a Paris-based address. So it's really trying to bring public borrowers, whatever that size, wherever they are located, to a central place where they can address a diversified base of investors, which will include banks, asset managers, big insurance companies acting directly, pension funds, and etc.
Fantastic. I'm aware we're running out of time briefly. I wondered if I should ask if there's been any questions from the audience that we hopefully will be able to answer very quickly. I'm not sure whether the technical conference organizers have either heard me or whether we perhaps received no questions, but we're coming to the end of our time now. I'd like to thank you both so much for joining me this afternoon and for such an interesting discussion. And thank you to the conference organizers for such a great day.
Thank you very much, Nina.
Thank you very much, Nina. See you soon.